today are Abhishek Kothari, co-founder Flexiloans, and Gayathri Parthasarathy, India partner and national head, Financial Services KPMG India. I now request Abhishek to come on the stage and give a presentation. Yeah, Abhishek,
Yeah.
please.
Gayathri, would you also want to introduce yourself? Hi guys, thank you so much for waiting for this. We'll try to make it as interactive and as fun as possible. We'll quickly introduce ourselves. Gayathri ma'am, if you can introduce yourself.
Sure. Good morning, good afternoon. I think maybe some confusions and a couple of people have been reallocated to some other sessions, I understand. So me and Abhishek are going to cover this session. We'll make it definitely interesting for all of you on what's really the product development and the go-to-market strategy, because this can come from different direction. For people who really want to, develop and what technology to choose or how do you really do a product management, and what are the consideration one needs to keep in mind when you do FinTech product, roadmap. And also go to market in terms of what are the considerations, key considerations, because this is something in between, right? Okay, because FinTech is expected to be very flexible. It has to be flexible. It's not the traditional financial services, so on and so forth. So we will cover some of those angles as we go on in the presentation as well, that Abhishek will cover. About me, I've spent more than 31 plus years in the industry in financial services, and I lead financial services sector for KPMG India across audit, tax, and advisory, which includes all of our consulting on risk, technology, and digital fintech, so on and so forth, and deal advisory. That's my quick little background. So all I know is financial services. So that way you can ask me, and also have had extensive background in technology as well. So financial services and technology, and the topic being in FinTech, I'm happy to be here, and I'm happy to be before you to sort of take this session through with the product development strategy and the go-to-market for FinTechs, right? Absolutely anytime, since it's only the two of us, please make it as interactive as it can get. So if you have, any thought that's there in your top of your mind and you would like to get an answer on, do not hesitate, and please do make this highly interactive, right?
Jiten is also here.
Oh, Jiten is here.
Yeah,
Fantastic. Come over, Jiten. Okay. I'm mobilizing the
Jitendra
panel.
Gupta from Citrus Pay has just come here. So
Like
now we'll
truly
carry
like
on
a
the
fintech.
discussion ahead. Yeah.
Yeah, just to introduce myself, Jitendra Gupta. My fintech experience is that I started this company, Citrus Pay, ran it for 5 years before exiting, and now I work with PayU as a managing director.
Quick introduction about myself. My name is Abhishek. I am a co-founder of Flexiloans.com. We are a digital lender which does lending for small and medium businesses in India. We're about 2.5 years old. Deepak there is my co-founder, and we're trying to create a product which is essentially for small businesses in India on how they could get access to formal financing, which is about 90% of underserved market today in India. So we'll bring forward our perspective on how we were building that product, and what are the pitfalls, what are the things that we should and should not do. So happy to be here. Yeah. So we can quickly convert this to a panel now, so that Gayathri can run this, and because we're waiting for you. So.
Okay, I'm sorry for delay. You have a presentation?
Please, why don't
Okay, you can. No, I'm not doing any presentation.
why don't you quickly run
So
through
what we'll do then is we'll make it very experimental. This is almost namesake here. So we'll do a presentation, and after a couple of slides, I'll take views from the panelists and add to that. What I'm going to present is going to be very high level in terms of how to build a product, but also going to some nitty-gritties of FinTech. So should be fun. Let's take it by the ear and see how it goes. Can you see the slides? Yeah. Okay. So what I'm going to cover is about 25 minutes of content on how are we, and there are different ways in which products can be built. So what are the things to keep in mind when you're building a fintech product, and things to keep in mind when you're taking it to market, because things work very differently from what you see in PowerPoint decks and Excel files to what it reality when it boils down to executing that strategy. So building scalable products and taking them to market is going to be the theme. I'm going to focus primarily on lending, particularly because that's one of the expertise areas, and also we wanted to contain something in 45 minutes because otherwise it could go all over the place. So here is a little bit of the fintech landscape, if you see. This is courtesy a company called Digital Fifth. They circulated this they circulate this every month, which is there are about 10 different types of fintech tracks that happen in India today, right? From consumer lending to B2B, to SMEs, to P2P lenders. It will go all the way down to payments in terms of B2C and B2B payments. It goes to wealth tech. There are a lot of digital enablers and so on. So when you start out, first of all, you have to figure out what is it that you're going to specialize in. And while at the outset, fintech looks like an amazing opportunity, there'll be different things that you have to keep in mind in terms of which target segment are you going after. I just wanted to kind of showcase this to you to show the complexity of fintech in India today. It's not as simple as it looks from the outside in terms of underserved and the market opportunity. There are different layers to it which you have to peel before you get into that business. Okay, so for most of us who know fintech, that it's kind of a combination of finance and technology. So when you look at the word itself, it's finance plus technology. But when you go down to it, there's an important element of product to it. That how you're going to build that product, and it might be a financial product, it might be a digital product, or it might be something else. But the whole product flavor starts to come into it. And it doesn't end there. The complexity is then how do you incorporate data science into it? Because the whole concept of digital lending and how does it all come together as a product has to be weaved with a lot of data science applications into it. And then there is credit risk, which is again an important part, because unless you can measure risk, contain risk, fintech, particularly lending, will not be successful. And then there is going to be compliance, because it's a highly regulated environment. So how do you take care of compliance, regulatory risk, and so on to put it together? And then there's operations, because India is not a purely online country today. The data is not machine readable. So how do you take all of this into an offline-online model, which most of the businesses will have to incorporate because of regulations, because of the fact that the customer is not digital savvy, because of the last mile connectivity and so on. And then there is the holy grail of lending. If you can't get your money back, better shut down the business. And so the collections part of it. And now you put it all together into a product, and it starts becoming a lot more complex than just technology coming into it and automating or accelerating certain things. And that's where we're going to focus on today in terms of, in this entire complex web of things that fintechs need to work in, how do you start creating a product which can be successful over time and can stand the heat of market cycles, risk regulations, our own internal risk, operations risk, and so on. So I'm going to just take a pause before I go into this to see if there are any thoughts that the panelists would have.
I'll add +1 there, just one more plus, which is future, absolutely thinking about the future, choosing your technology. Because what technology will you choose, and to develop all of this, because it's an integral part of fintech. So I would add that as a primary feature as well. All this is very important because, and also very, very clear in terms of what is the landscape that you want to play on. Because that compliance part of it, you need to be clear. You can't build something for a particular country and then try to say that I will try to operate in another country, because it's a pretty difficult thing, right? If you are developing an fintech kind of a solution in health science, right? And if you want to sell that in US, then you know what it will be in, right? To touch it every single aspect of his power. Whereas you can try to do a financial services thing in India, which is like more working with in between on a traditional bank, financial institution to what it is. So two things, you need to define your area, the geography that you will play with, and the technology which will enable you to make it future-proof, right? That so that you can make it flexible are very, very important.
Yeah, very true.
Yeah, I clearly agree with her. because the fintech products by nature are mainly designed to meet the needs of the country or the particular community per se. And that's why if you look at it, very few fintech companies you see are global in nature. Most of the large fintech companies are pretty much one country or similar countries where they are present in. That's why if you look at India, when it comes to payments, while there have been like PayPal, who was super large outside India, there are companies like ADN and Global Collect and all of those companies which are very big and very large globally. But when it comes to India, these companies generally struggled and or made very, very late entries to come to India because of the local regulations, because of the local nuances around how to create businesses in this segment. So I think the fintech products are generally complex because of the country's specific nuances and compliances.
Perfect. So with that, what we'll do is we'll get into about 10 steps that I think are most important to create a fintech product, and they'll be very generic in nature. So please feel free to ask questions at any point of time, and we'll keep taking pauses to see if there are any thoughts that you guys want to share. Okay. The first and the very most important thing before you start building a product is about having a vision for it. And the vision drives a lot of things in terms of how the product is going to be delivered over time, because what you know today is not going to be enough throughout the journey of the product. So taking the example of lending, today lending could be classified into various forms, but traditional lenders would take about 15 to 20 days in order to do any kind of successful disbursement. And fintechs like us, what we're trying to do is take that time to zero. And that time to zero, the money in the same session, may be possible 3 years, 5 years down the line, because a lot of things will have to be coming into place. But the vision drives every aspect of the product in terms of how it is going to be built. So having a product vision is the most important thing, where organizations sometimes get into it thinking that we will automate certain stuff using technology, and that is going to help us build a product. But that's not the answer. That is just technology to it. There is no product layer on top of it. So having a vision is very important. And then the moment you arrive at that, the second most important thing is going to be the mindset. So how do you, and the previous panel also spoke highly about the fact that the mindset is very important to be able to drive any kind of change. So there should be many entrepreneurs here who've done this in the past or are doing this, and you'd agree that the most important bit is how do you align people for change? This is a man versus machine problem. There are people who've done this job successfully in the past, which is underwriting, which is risk controls, which is lending. And the moment you start taking this to a machine, there is going to be resistance. In fact, if there is no resistance, which means you're not doing a good job of delivering a good product. Because unless that resistance comes through, there's going to be a point where it is a comfort zone, and that comfort zone doesn't really drive product innovation. So mindset, man versus machine, change management, those are the things that you will align the organization before you start building a product. And I can take a pause here and see if there are any experiences that you guys would want to share in terms of in your own organizations as startups or enterprises. Are there points where you've seen that resistance towards change, and how have you handled it? Because those experiences would be very valuable for everyone to know.
Absolutely. I think the challengers are the triggers for making the product successful. If the challenges do not exist, then you're really, whatever you're thinking of developing is of no use. Because it is like, sort of, it's like, maybe a BAU kind of a thing, right? You have to rethink. So would like to hear any experience where you have reached a rethink state or you had a lot of challenges.
So I'll give 2 examples from my side. So one in payments during our citrus journey. So in 2012, we realized that the online checkout needs to be much more simplified as compared to what it was back then. And we sort of came out with this offering where we said that if we can store the card for a faster transaction, I think it can change the experience of the consumer. Now, when we discuss this literally within our company, outside our company, with banks, everybody was like, no, that's not allowed. It's not safe. Well, I agree it's not safe, but it doesn't mean that should not be done, because What you have to worry about is then how to make it the fail-proof and pretty secure, but at the same time not compromise on the experience. And this is where I take pride in saying that we were the first one who introduced that experience in the country in the online checkout. Back then it was skepticism. Now it is kind of accepted norm, where every website or every app sort of stores your credit card or a debit card information and allows you to transact faster. So that was one example. Huge resistance, by the way, from our product team, from our banking partners and everyone literally. But we just pushed hard, saying that this is what we will do and we want to do this. The second is our current product, pay later product, Lazy Pay, where when we came out with the product, we said, while we are giving loan, we won't do KYC and we won't ask any income proof, we won't hit bureau, but we'll still underwrite. And when we went to banks to say that we want to do this and what's your view, literally all the banks started laughing and they said, in India, to recover 1,000 rupee or 1,500 rupees from a consumer who you're not taken his address or his ID or his bureau hit is very difficult to recover. And as we speak today, we do 2 million loans a month. So the product has scaled very well. Delinquencies are less than 3%, which is better than even when the banks go and do physical verification and collect all the IDs and everything. So we sort of able to crack that, and of course with the help of machines, I would say that. But these are the things which you have to sort of aspire first, and then you have to work towards. So the vision thing which he talked about, so clearly whether at a single click, how can you provide a loan? I think that's the vision. If you have, then only you will work towards it. And on day one, you're not going to achieve that. You will sort of falter during the journey. You will see there will be a path to it at the day when you will reach to it. But at least you need to have that vision. So clearly, we have seen two such instances when we aspired for.
Any instance on either the resistance and then acceptance? There. A mic, please.
Sure. Yeah. Akilia Gonsalves here. I'm from Baytree. We're building a marketplace for impact investing. So using a FinTech platform to bring together institutional and individual investors, India, overseas, and connect them to for-profit, early-stage enterprises that are working in the social space. And the biggest resistance we face actually is from the investor side in terms of adaptability to a tech platform. Everyone is used to having everything in their inbox. So the whole fact that they have to sign into a platform to even view curated deal flow is a challenge we are facing at the moment. And interestingly, it's more from the Indian investors. We have big institutional investors overseas, but they're a lot more ready to log in versus Indian investors. And that's something we haven't figured out the answer to, but I guess that's the joy and beauty of working in a startup. We'll work our way through that. But I just thought that's something that would be useful to share.
Wonderful. That's very true. Absolutely. Yeah. And good that you have resistance, because that means it will get sorted out. Okay.
Just now you said, earlier panelist, that they give loan without KYC. Am I right?
Sorry?
You give loan without KYC,
That's right.
which was a unique feature in your loan disbursement system.
Yeah.
And your result is very good, only 3% bad debt or whatever. So it is a really a good information for us who are doing a lot of activity for KYC and all. Now, I am in receivable management services, where I help for getting recovered money if it is overdue. So my question to you is, you loan to which type of customer? Just to have an idea how it is so easy for you.
Yeah, that's an interesting question you asked because if somebody would follow my advice blindly, they would go bankrupt. So, so clearly that matters a lot in terms of which segment of consumers you're addressing to. So generally, the segment of the consumers which we want to address to is not 1.3 billion population. We want to address to only the top 50 million population or top 70 million population. And what we inherently saw is that, like in India, there are only 15 million guys, unique guys who have credit card, and that too, each guy has 1 or 2 credit cards. But that doesn't mean the others are not eligible for credit card. So we sort of typically address to the salaried guys, persons who are very, very digital savvy. They transact digitally very, very often. And that's the segment for us, which is very, very easy to assess, considering their behavior online, considering how often they shop. We are able to find out their geolocation. We are able to find out what typical age group they would be having, considering what they're ordering, where are they ordering, how frequently. So I think we are able to assess that. So, so the segment of consumers matter. It's not a blind
The moment
call.
he said salaried, they are no longer unsecured loans. On paper, they will be unsecured because you are not doing the process. But they are more or less, right, in terms of, because they do have some backup at least, in terms of the knowledge of what your customer segment is.
That's
a
right.
very targeted customer segment, highly targeted.
Right. So it means, though you are saying you are not taking information, but you are giving loan to only those people whose informations are available somewhere else without asking him.
That's right. Or when you are, let's say you are ordering food from Swiggy, then the Swiggy will provide us the information to check whether you are eligible or not.
Thank you.
There's one more question there. There's a question there.
So this is regarding lazy pay. So you told us that it's 3% default rate what you are experiencing. So who pays for this? Like in case of if I'm ordering from Zomato and I select lazy pay, so how the maths work? Because I guess Citrus is just a payment gateway and you have very thin margins. So how do you make up for those 3% or whatever the default rate is? Like, are you taking more charges from the, say, Zomato or Swiggy, whoever is using your payment gateway with that lazy pay option, which in turn is compensating for the defaults which are going to happen? I'm sure there must be some amount of defaults. So how does the maths work? Because this is really, I mean, my question is related to who pays for the defaults?
Sure. So, so like in any credit behavior, the good consumer pays for bad consumers. So it's like this where the merchant pays us for almost all consumers, but because that's the option which they are consuming to accept payments. But at the same time, generally the segment which we see is there are 2 kind of segments. So one is a segment like probably you and I, who don't need a $10 credit to buy food, but still we use it for convenience. So that's a good segment. And then there's a other segment which do not have a credit card or do not have a credit option per se, and they use it. Then they sort of use it for availing credit for X number of days, and then they pay us as late fee or something. And out of those, some users don't pay us at all, so which is okay. So I think net, the good consumers and people who are paying late, they make good for bad consumers.
And one more follow-up. Like you are providing a credit. So, I mean, is it whether it can be done through an NBFC route only, or you are still just a payment gateway? Because this is the kind of credit which is being offered. And as far as I understand, I think it's going to be for a shorter duration. something like 10, 15 days. So whether this is under an NBFC thing or whether the payment gateway company is doing it.
We have our own NBFC.
Okay, thanks.
Just a small request. If we could
because
limit
this
the
is going to
questions
the-
to product development and go-to-market, because there's a lot of people here who are interested in that. Rest can be done post the panel in terms of other questions to the speakers.
So my question was that how did you actually market LazyPay? Because why wouldn't I take a credit card from a bank versus why do I opt for LazyPay? What's the value add that you bring to table?
I think so. While I don't want to hijack his session and presentation, but just the last answer. So I think the LazyPay is positioned around the seamless experience for your checkout. So if you look at it, what happens in the payments world when you make online payment, after the customer selects to pay, there is a good 10-15% drop. And that drop happens not because the customer wants to drop the transaction, but either your phone conked off or your internet issue or the OTP didn't come and all of that. So people see this as a frictionless way of paying. The good segment, which I said the 50%, other 50% are the segment who do not have a credit option. So it's sort of a mix of both, and that's how we get the consumers. And the proposition is so strong that the consumers gravitate organically more. But over to you, Abhishek. No. Sorry.
There will be a lot of questions for Jitendra because he's built such a successful enterprise that. So any questions further before we move to the next one?
Hi, I'm Hemant Jain from Tavaga. So I have questions for both of you actually. In your journey as an entrepreneur, particularly in early days, what kind of go-to-market strategies worked for you, and how did you evaluate the effectiveness and where to invest? So that entire process, and also the second question about the product development in terms of adding features to the product, right? So how did you determine the priorities, right? Was there some kind of alpha testing or the entire process and thinking that went about determining how you go about adding features to the product and the priorities for those? And also the go-to-market strategy.
So we can take the go-to-market question in the separate section. Your current question will actually be answered in the subsequent slides. But having said that, your question is really about how do you keep building the product and keep evaluating the fitment with the market without having a lot of overheads to it. And that is one of the things where you would have to be agile, you'd have to build MVPs, and you'd have to do a lot of research, which we'll cover in the subsequent slides. And particularly go-to-market will be answered, definitely. Okay, just moving on. There's the third, and I think my personal favorite in terms of what is it that limits us from building cool products and great products is the ability to imagine the unthinkable. I'll take some examples. Think about it 10 years ago of whether these were possible or not, or whether you were thinking about it. But there's some movie where you saw it and you thought that this was really something that could change our lives. Iron Man, lightweight armors. Today, US Army is actually sending soldiers in with lightweight armors put in, and it saves lives. Voice control devices. Many of us would have Alexas and Google Homes in our house, and how they make our life easier and how voice to text to actions is now becoming possible. And at some point you saw it in a movie somewhere. Wireless charging, 3D printing, wearables, biochips. So just a quick trivia on this. There was a movie called Woman on the Moon, which was about space travel. I'm sure most of us haven't seen it because I think it was a German movie, and it came in 1929, and it was in 1957, which was 28 years after that Sputnik 1 was launched by Russia. So it took 28 years for that imagination to become reality, and reality in the sense that it could actually impact our lives. Space Odyssey, portable tablets. They were seen in 2001. Most of us would have seen that movie. And the first iPad came in 2010. So it took about 9 years for something like a portable tablet to actually come into our hands and make our lives different. This one everybody would have seen. Minority Reports, Tom Cruise, great movie, gesture control devices. Came in 2002. Okay? Everybody was fascinated. It was a movie about storage of memories, gesture control devices, everything else. 7 years after that, when Xbox Kinect came in, and we could actually play games using gesture controls. And what I'm trying to prove is that the time from reality to imagination to reality is shrinking very fast. What took 28 years, about 20 years ago, is now taking about 5 years. And so we are only limited by our own imagination in terms of what we could build and deploy. Because there is an immense amount of computing power available. There is immense amount of product and tech available to make things happen. And the only thing that we all need to do as product managers is to innovate, keep thinking about what is not possible, and then make that possible. And this, I think, is my personal favorite in terms of what great products are built for. Not doing KYC is actually a great point around that. I mean, it would have taken someone actually 5 years to go around that regulation and do something about it. But you do an action, and then you see that it's working, and you bring that as a part of BAU. So imagination, being bold, being creative, those are great elements of how you could build a great product. So if you don't have guys who are challenging you on a day-to-day basis, which means you'll not be able to create a great product. Okay, I'm going to cover some of the other ones quickly. Most of the times, and how many of you are part of a product team or are part of a founding team where you're creating a product? Just a show of hands. Okay, it's about a good chunk of people.
Good chunk of people we have. Yeah.
How many times have you been given a requirement without being asked for your opinion? Okay, build this. This is my list of requirements. I want this because this makes my life easy. If your answer is less than 90% of the times, then you're probably in a good team. Basically, what happens is we confuse between product managers and project managers. Okay, so the idea to build great product is not to write business analyst requirements and then get it done through technology team. The idea is to do research. The idea is to discover what the real end user is facing, ideate on it, develop something, create something, put it into deployment, and the cycle continues. You research on your new MVP and you see, okay, it works, it doesn't work, and you continuously innovate. So if you are someone who's giving requirements, make sure what you give is your pain points and not your requirements. And we've seen this in the last 3 years of journey, that we've come a long way when we start thinking from requirements to pain points. So what you should capture as product managers or what you should give as business stakeholders is not requirements, but what is it that you're trying to solve. So my problem, for example, could be that I want to lend money faster on a checkout journey. And then the product managers or the ones who are responsible for it will come back to you with ideas about how you could completely transform the experience rather than saying, can you make this page load 5 seconds faster? Because that's something that is not really product, it's just technology, and it's without a thought process, it's your requirement. It's not really solving anybody's problem, which could have been solved in a very different way. So I'm going to again take a pause at these two, imagination and research, which are important for product.
I think it's a very, very important point for the people who are working on the product development. And product matures only when you really think, do a lot of research time, and try to solve finally the usage, where it is going to be used, and that problem, if it is not going to be solved, then whatever you are doing is normal software development. It is not product development. Because there is a huge difference between normal software development versus a product development. And that differentiation has to happen only when you look at it from the other side of usage. Normally, you'll see that this is what I'm going to give it to you versus this is what is needed to be served, and hence I'm developing for that need rather than what is my capability. So you have to look at it from the lens of what is the need and not is what will be delivered. And that is very important for product maturity, and that will also play a role on your product life cycle, on what you can add at one point in times. What is your real MVP 1, 2, 3, and then maybe a little stable product, and then another MVP 2, 3, 4, 5 for the next maturity for the product, etc. So remember that it is need-based and not your capability-based.
Absolutely.
That is really important for FinTech product development criteria.
And I'll just add, I think the product development has to be clearly done in synchronized with what is that your end consumer or the user is expecting. My problem with most of the product managers is they idolize Steve Jobs. And most of the product managers sort of say, and which I have a big problem with, that, users don't know what they need. And which is what the Steve Jobs used to say. Now, there is a one great guy. It doesn't mean all of us are great. All of us are still, we have to, maybe the Steve Jobs knew exactly what users want, but I'm 100% sure 99.9% of us don't know what users want. So we have to figure out what users want. We have to know what is the problem statement they're facing, and that's the problem which you have to solve rather than sitting in your conference room and solving it.
Okay, so yeah, we've talked about vision all the way down to research. Let's get to the next. So from a lending perspective, one of the other things which is very important is there's India and there is Bharat. And it is not pure tech, it's not pure offline, it's somewhere in the middle. And when you're creating a product, you either create it for India or you create it for Bharat, or when you're targeting both, then you need to have an online-offline setup. And by offline, I don't mean branches. People often get confused by the fact, by offline, I mean having some kind of an on-ground presence in whatever way it is to meet the regulatory aspects of it or to meet the risk aspects of it. So whenever, at least in the lending, what we've seen is it's not man versus machine. It's basically human intelligence plus artificial or machine intelligence plus a lot of process innovation that makes successful lending enterprises. And you can open up any case study across the world. It is what you see from the outside is a flashy website, but in the background, you would see a lot of on-ground operations, at least in India, where you'd have to make the last mile work in order to make it work for you. And I use this analogy with my team always that it's not that we are trying to build a transformer, which is a cool machine which will do everything. We're not trying to build a Superman, which is a superhuman who can do everything. We're trying to create an Iron Man, which is essentially a human mind controlling a lot of machines, imparting a lot of wisdom, but also making the best use of all the machine intelligence that we can get to maximize the output that we could get from that particular setup. So Iron Man is what I think we're building, and most of the organizations that I see which are successful in India have built the online, offline, or the last mile, or the AI plus manual intelligence setups. That's one, and related to that is once you start building it, and that partially goes into the point of what you were saying, that go agile. And every company that starts today says we are doing agile. And when you go down to the depth of it, and I can take a bet on it that 90% of the companies don't really know what agile means or follow agile in its true sense. So agile in a very crooked form has become like rapid development, no documentation, and imperfect requirements, and not going towards a particular MVP, and then building a product which may be clunky, which may not scale, which may need a lot of rewrite, and so on. So get an agile coach, get a scrum master to run things for you if you don't know or if you feel that you're not agile enough. Investing in those kind of things works. And again, these are experiences that we've seen over time, that once you get into that process, and it goes back to my earlier point that if you're not feeling resistance from your engineering teams, you're not agile enough. If you're not doing stand-ups every day, if you don't see groups standing up every day and working towards the daily scrum, then there's something wrong and it doesn't work for you. And you will only see the power of it after 3 months of continuous investment into an agile methodology. So get a scrum master.
And agile also means, right, you need to look at a little bit of an agile on truly how you can be agile end to end, right? Get the all relevant people. It is just not for the coders to be agile. It needs to have a decision maker, a leader. You need to have a scrum master. You need to have a business who understands the business, a person who can code it, so that it's to me, it's like literally building something, the Iron Man maybe, the miniature of it, right? You build it, but some part of it or a miniature of it in a garage, right? Okay, truly agile comes in when you apply that in a serious mode, because that's the real agile. Because otherwise, it will go in again in circle that somebody will be ready for agile, but somebody else is not yet ready in terms of the life cycle, because the ecosystem has to run for agile end to end. That is when it becomes really agile. Okay, that's very important. Yeah. Very, very important.
Yeah, I think what Abhishek is talking, and he said very fast, but I think he said very, very important things about the daily scrums, stand-ups, having the relevant stakeholders discussing what's the requirement. I think it's so important. And I have seen in our company, in companies elsewhere, the end product coming as, and then the business team says, oh, this is not what I asked for. And this is so common. And following this boring daily routines actually gives you the flexibility to change during the product development cycle if there is anything not meeting the expectation. And I mean, that's like super important as per me.
And also have a product owner, according to me, who will run that.
Yes, and product owner is absolutely important.
Very important, because with a product owner, you make sure that agility can come in with an accountability, right?
Yeah,
that you can get things done.
Okay, so a couple of us spoke about MVP already. So I particularly love this representation in terms of how we think MVPs are and how in reality MVPs should be. So how people build MVPs today are, let's just create a piece of code that does something, but it may or may not fit my end goal. So people confuse between the fact that Agile or Scrums or building MVPs is a part of a larger goal. And most often than not, we actually do not think of the larger goal. And that goes back to point one about having a vision. So if in this case we knew that we were building a car, we would most likely take approach 2, where you'll have something with 2 wheels. It'll take you from point A to point B. And then at some point you'll realize that, no, I need to steer it better. So let me put a handle on top of it. And then I need to balance it more, and I need some comfort out of it. So let me create a bicycle. And then eventually I need to go faster. So let me create a bike. But what I'm doing is I'm reusing things. I'm reusing the wheels. I'm using the same tech. I'm using the same speed methods. I'm basically not spending time rewriting the code again. And that is the beauty of creating MVPs. So go back to your points where you've realized that, hey, I wrote this monolithic piece of code, and this is not usable anymore, so I'm going to write it again. And that is where you know that your MVP has failed, and the reason is probably you did not think that you were building a car, you thought you were building something else. And again, related to this is many a times you'd come across distractions. And I again particularly love this because it very succinctly puts forward the point of everybody trying to do blockchain. And not many people really knowing what does blockchain can deliver, what are the right use cases. But hey, let's do it because it sounds cool. Let's do it because I think it makes me look good. And those are the points, again, you have to stay clear of those distractions. So separate your product team, which is building on the core product, solving a core problem, from your research team, who's trying to do something else. It may be of value, it may not be of value, but don't mix the two. I've seen a lot of people, and you'd come across, I mean, if some of your engineers here, you would realize that we always want to learn a new technology. We always want to do something new. So newness is a cool thing, and everybody wants to do it. But as long as you're part of a startup of an enterprise and you move towards a common goal, that common goal is the product, and research has to be separate from that. So don't do blockchain if you think it is just for fun and not really going to add a lot of value over time. Again, your thoughts?
Yeah, no, I think clearly while building the payments company, literally every quarter or every 6 months, and generally nowadays the world is so well connected that you read about what's happening across the world, and somebody comes out with the idea that you blink your eyes and then payment is done, and then you swipe your hand and payment is done, and some random ideas. And now, and the product managers are always, and the tech guys are always sort of crazy, and they're like, oh, we should also do something like this. We can change the world and all of that. But one has to be practical in terms of which is the market you're operating in. And payment, and especially in our business, the payments business, I think changing the consumer habit is the most difficult part. So you suddenly can't train millions of consumers saying that you have to go and blink your eyes when you go and make payment. Your intuitive behavior is still put your hand in the back pocket, take the card out, give the card, the person swipe. That's your intuitive behavior. Now to evolve from that may take years, but you suddenly change your company to saying now onwards we are going to just focus on blink your eyes. So I think that's a crazy thing, and this is what Abhishek is calling distractions. So one has to be very clear in terms of what is your market segment and what that market segment is can potentially adopt, even if it is slight improvement in the behavior. But if you're doing a sea change, then you need to also be ready with the gestation period. which I'm not sure how many companies have the ability to survive as a long gestation period without somebody else believing in the idea.
Okay, very related point to this. Don't use things, but do use some things which are available now. I sometimes feel that FinTech should have been called FinData or something, because tech is kind of becoming a leveler for everyone. It doesn't give you a great competitive advantage. But what, at least in lending, what gives you competitive advantage is the fact that you've got ability to assess customers in a very different way. You've created models which can consume different data sources to throw out a credit risk for a borrower. So use the immense amount of computation power, data, big data abilities that are available now in order to make either your assessment more accurate or consumer journey more effective. And follow computer vision, follow OCR techniques, follow how anomaly detection and fraud detection are being done today. There's immense amount of open source algorithms available. So it's not that you have to invest in getting people who could do this. There are a bunch of companies like Google, Microsoft who are open sourcing most of their machine learning libraries in order to make that easier for you. So use pre-trained models, but experiment on things that data science is offering you in order to make consumers' life better or your assessment better. And that's, again, one of the important points. And that's the last one that I'd say, that again, I've seen it various number of times, that lenders particularly would focus most on the front-end aspect of it, that let's get customers in, and the onboarding part of it, and then it kind of goes to the assessment part of it. But what you forget is that until your money comes back, you've not made profit on it. And the money comes back on the 11th and the 12th EMI, not in the first 10. First 10 is only principal coming back. So effectively what you're saying is, what I'm saying is, don't forget collections tech. It is equally important if you're part of a lending institution or anything else where you're collecting money back. Probably you should be more worried about the fact that my money is not coming back, and tech can play an important role in getting repayments easier. Use UPI, use many other methods that are coming into place now in order to get your money faster, better, cheaper, easier, and start focusing on that. So those are my 10 steps towards building a good fintech product. For the last ones, I'd again welcome your inputs.
I think sure, we would like to get some questions from you on this thing. Otherwise, we can spend some time on the go-to-market.
Go-to-market, we could do that, yeah.
We can
So
do
there's
that.
a question. And the next one.
Hi, Abhishek. My name is Bipul Nathani from Collecto. Could you throw some more light on and information on tech-based output on collections that's happening at your place, which could give us larger insights?
So I would kind of, luckily we haven't seen a lot of defaults to actually focus a lot on collections, but that's a good thing. Look, from a collection standpoint, there is a data source part of it, which is using data to identify what is your probability of collecting from that person, from that borrower. So more often than not, we believe that having an Excel spreadsheet and just calling everyone n number of times could get your money back, which is a brute force approach. What we use is a bunch of models which will tell us what is the most likely person who's going to give our money back, which also goes to the fact that what is the next action? Is it about recovery or is it about restructuring? Because if you look at lending, there is two key points. One is ability to pay and one is intent to pay. So when there's an ability to pay issue, you can actually restructure things and make it easier for the borrower to repay your money. But when it is an intent issue, then you resort to other things. And that is where some of the models will, data of how they borrowed. There is immense amount of research right now going on in understanding speech and identifying insights from it to see what was the customer intent and can we identify that from the phone call that we made to them, tonality, pauses, number of questions, the amount of time you spent on asking questions, and did you get your answer in the first instance or not. So that's one. That's on the data side of it. On the collections tech side of it, it is primarily...
More in terms of the engagement part of it. How long are they engaged with you? Which will determine in terms of, right, that data points gives you the maximum intelligence in terms of whether they're serious or not. Right?
Yeah, most of the times lending is all about, is the customer coming to you or you're going to the customer? So if you see a lot of intent coming in from the customer in terms of phone calls, emails, clicks, etc., you know that the customer is engaged. And if you lose the customer after the loan is sanctioned, he's never come back to check the EMI statement, you know something is wrong. Okay. And the tech side of it is purely automation, which is can you automate that process in such a way that you get to the customer faster? So a lot of customers, it is amazing how cohorts of customers would behave. For example, we've observed that when we see delinquency in a particular region, it starts to consolidate in that region and more people default from that area, probably because of the fact of the hyperlocal intelligence system that would run offline. And so you have to get to the customer faster. So if the customer knows that if I delay by 2 hours, I'm going to get a call, he's more likely to pay. And that's where collections tech would help you get to the customers faster.
Thanks, Abhishek.
There was a question
Maybe
there.
I think given that we have spent a lot of time on product development, we should also spend some time on the go-to-market.
Yeah.
We are already
so we'll take
15 minutes.
two more questions and then move to that because they've already.
Yeah.
Quick question. My name is Mayank Pincha. I'm early stage startup enter. I have a question for the previous slide. Can you share some use cases for these technologies in the FinTech domain?
Plenty.
Just a few.
There are about 30 different kinds of documents that customers give you to get a loan. Developing image recognition to identify what those documents are, where there's an army of 20 people classifying those documents and saying, okay, this KYC is done and this is not done. That could be, if you follow Andrew NG says that if a human mind can do a thing in 2 seconds, that can now be automated with 100% intelligence. Driverless cars are an example of how the driving is separated into 2-second intervals and taking decisions. So effectively, image recognition has a huge application in almost every industry today, not just lending. OCR again goes to the same philosophy of the fact that can I extract information from a PAN card, Aadhaar card, or a shop establishment certificate and identify and verify that the address is same as what the customer is given in the form. Reduces your turnaround times. Fraud detection is an easy one. Can you find out data and anomalies in that vast data that the customer has provided you, not in terms of your PAN and Aadhaar, but more in terms of speech, video, interactions, website time spent, who created the form, whether it was them or their chartered accountant and things like that. And you put it all together and you will realize that you can find that anomaly of fraud, which you could use to eliminate fraud.
Okay, sorry, I had absolutely the same question. Just
Great.
Any suggestions on a resource bank from where we could get
resource planning?
Resource banks?
Resource bank.
Open,
where can you find such technology?
Yeah, you said you should go for open source if available.
So resource banks, you could do, you just look for open source libraries. Microsoft has, so if you're looking for...
Both Microsoft and Google, I think.
Microsoft and Google both. So if you're looking for most face detection or OCR, Microsoft is good. OCR, Google is better. Face detection, Microsoft is better. And then you can research for those. There are plenty of those available.
And they are open source libraries, so you can adopt to what you're doing. Right. Sure, perfect.
I can share a list with you. Oh yes. Thanks for writing.
That's also.
Alibaba is another one where there's a lot of open source content available. Okay, in the interest of time, I'll quickly summarize what I wanted to share in terms of go-to-market strategies. So a lot of us come across this phrase like product market fit. And what does that really mean? And there are different definitions if you ask different people, but effectively a product is successful when you can find a market where that product fits. And literally what it is called is the market is good and the product can serve that market where customers are willing to pay for it. And that's the product market fit. So first of all, the first mistake that most of us make is we size the market incorrectly. We size the market for investors. We don't size the market for really the business. A simple example, India has about, 5 million underserved, 6 million SMEs, 60 million SMEs, 40, 50 million are underserved. But then you get to the point that how many are really reachable because half of them are rural and you get to 50% of the segment. Then you say, okay, and how many of them really need your product because they're not in a business where they need loans at a click. And you get to a smaller segment. And you say, okay, but how many of them are really willing to pay an 18%, 20% interest rate because we can't compete with the bank in terms of our cost of capital and it reduces further. So having an accurate market size assessment is one of the most important things that most of the entrepreneurs fail to do because it is about proving to someone else that there's a large market out there. Thank you.
Go-to-market strategy.
So size your market fairly, size your market for yourself, but then it's not just the sizing. When you start reaching out to those customers, you have to understand those customers. India is full of price and amount sensitive customers, and I'm talking from a lending perspective. So there are customers who are amount sensitive. I want 10 lakhs of money because I have an order to fulfill. If you give me 9 lakh, it doesn't work for me. If you give me 8 lakh, it doesn't work for me. I'm not worried about the rate. I'm worried more about the amount. And then you go to the other segment of customers who are always looking for the lowest interest rate, who would better off be with banks than with NBFCs because you can't match that rate of lending. And then as you move further towards a digital savvy segment, you would realize that you're coming towards a time sensitive segment. So e-commerce, people who are online, people who've understood the business of trading, where you get raw material from China and sell it to someone else and you make a margin in the middle. And mobile operators, all the mobile shops that you see today are basically fast traders. They run on a 2% margin. So for them, it is about how many times can I roll my inventory in a month rather than about amount or rate. And so they're more time sensitive. They value their time more than the rate because they know they can use that money 5 times in a month to make more margin than the interest that they're going to pay to you. And then there's a very small segment in India today, really, which you and I are, which is the experience-sensitive segment. It says, okay, I am going to value a lot of things, but I'm going to value experience more. I like to give a 5-star rating to an Uber driver. I like to basically reward people for their good service and also go back and buy that same product again from that company because I value so most of us have focused on the product UX part of it. And the one thing that we completely forget most of the times is the service UX part of it. That are you providing the right service? Because customers expect service. And there's nothing which is completely digital. There's always a call center. There's always a grievance cell. There's something where you need to provide a good service. And that is where most of the Indian companies fail because that experience sensitive segment, if latched on to, can actually deliver great value, but we don't do a good job at that. So those are the 4 segments. The idea is, depending on which business you are in, you can have different segmentation around it, but identify who's the real core customer who's going to take your product and keep coming back to you. And then go deeper and deeper and deeper into that segment, no matter where that customer is. Invest money into digital marketing to find that customer. Invest money into offline associations where you can find those customers and then bring them in and retain them. And that's how this cycle continues. So your thoughts on that?
No, I think very, very relevant. And while you spoke about the lending, I would say just link it to payments world as well so that you get a broader view. So in payments, like I ran a company which was in B2B payments mainly. And then we said that how do we go after clients? And when we sort of segmented the market, we realized that in India, at that point I was talking, which is like way back in 2012, there were only 150 odd websites or apps which were large enough to create a scale. And then there were around 200,000 small SMEs which existed, which had a potential to accept payments. Now, when we further dwell deep, what we realized is that if we go after those 200,000, maybe it will take us 10 years to build the company. And plus the cost of acquiring those consumers would not justify to run the company. So what we did is we said, while we saw that 200,000 or 150,000 could become large going forward, so we segmented our teams in 2 ways, where we said that these 150 guys, there are 3 or 4 guys who will go after these 150 guys and acquire and convince these guys to use our product. And for those 200,000, it doesn't make sense to have a single person selling. Rather, we'll have an inbound call center or a service center who will just cater to these needs. And we focus on a product where they could self-apply, focus on digital marketing, the people could self-apply for the facility, and then only the customer service guy would cater to rather than able to afford a salary of a salesperson to convince those smaller guys. And that really gave us a pretty good ROI in terms of how we could scale better.
I think, I think very important points in terms of how it could mean time sensitive for a certain set of or segment of customers, or the experience, right? That holistically what people will look for. So really look at in terms of what your product's objective is to meet, and hence which area that you need to tackle in the go-to-market strategy. If you don't marry the two, obviously there will be a lag, right? You're not going to be fast enough to handle the ask or the need of the customer. That's something in my mind very important. And always go to market, right? Once you have assessed and sized the market, and sizing the market itself is important, and you know where you are moving up, make sure that we are looking at in terms of increasing through various mechanisms on increase the addressable market, right? That is because most of the times you will find that it is underserved, not that it is overserved. Because financial services overall, it is underserved as an industry, especially in the example we saw on lending or anything, it is underserved. So try to see from the last line you saw that the underserved number is so much, to going to the top in terms of saying that I only get maybe a very handful people who will be looking at the product. How you can increase that portion can happen only through giving them the experience of your product and reachability of your product and the access to how quickly they can work to that product. So you have to look at from both chains in terms of seeing how you are getting the addressable market addressed and also the segmentation that is being addressed. I think those are two key messages, I would say, right? Any questions on this? And we'll also check with the, how much time do we have? Last question, okay. So maybe we say last two questions, that's it.
My question is more on the lead generation part of it. How do you reach the target segment?
Yeah.
Because that is what finally matters. So broadly divided to two parts. One is on the loan, which I believe is more of a pull where people do come to you. And I'm more on the investment side where we help people to do investments, which is more of a push. So, any experiences you have on, how to reach to, and how to do a lead generation, because it's on the investment side, I've seen it is more of a relationship based rather than a digital marketing, where it's difficult to get leads digitally, or the cost of acquisition is pretty high. So any thoughts any of you can share on that?
Let's start with maybe anything that is a push, or rather anything that is a sell very clearly and not a pull like loan, right? If it is just carpet bombing by digital marketing kind of a thing, will not work. It'll not work. It'll yield you maybe a micro percentage of what you really would like to achieve as a result, right? Two things you need to prove. What is the value creation that you are providing for the customer? So number one is, what is the value creation, right? Even if it is investment, what is the value that you are going to provide which they will not be able to do by themselves or through anybody else, and you are the right person. And also paint a picture for a period of time on the journey on what if they get into the investment habit, what it will solve the goal-based savings, right? Kind of a thing, right? If you really look at it, convert investment into goals. If you convert it into goals, then definitely you're going to get better results than just say invest, right? Investment plans. So you need to be innovative on what is your value add there. That is the way you will attract people. Today in India, anybody you look at it, what is my goal? My goal is maybe there is a holiday plan that I need to see these two countries with my family. I need to save money for my daughter to go somewhere to study, or I need to do this for, my corpus that I need to build for whatever I need to do, A, B, C, D, E, F. That is the goals. So anything with respect to goal-based, if you really look at it, then it is a little bit more easy than a plain push that you will be able to do. So convert it into value, not just, through digital marketing or anywhere.
And I'll just say, frankly, the running investment business is the most difficult business, frankly, because the discovery of the product is the key there, and which is the most difficult. If I knew that how to solve that, I would be running that business. But there are good companies like Orowealth or Fisdom, and all of these companies are doing pretty well there. And I must say, it's time to see, or basically we should learn from them how they have been able to crack the problem. If you ask me ready answer, I don't have it. But at the same time, I'll just say the next step, provided you solve the discovery problem. I think the product proposition is very, very key in these kind of products because it's a relationship-based product. So, so how do you drive relationship with the consumer from his experience standpoint, from the value you are giving, from the advice you are giving? Because if his experience is better, in these kind of products, generally a reference works better. So the person is going to refer the product to his friend or family or whosoever he knows if he gains adequate advantage out of the product experience. And just taking an example of the goal-based product, if you like the way, well, she said the goal-based product, but just extending the argument there, let's say if the goal is a vacation to Singapore. Now, I think the value you can add to the consumer there is how can you get additional benefits of the person going to Singapore, not just saying, I invested in mutual fund and then you got a 10% IRR in 1 year and then this is what your investment value is. Now you can go to Singapore because your goal was saving 100,000 rupees. But if you can give the consumer a 100,000 rupee goal, which anyway he needed a cash, but some discount on his travel ticket, some discount on his stay, some discount on his, some tips on what he should do and XYZ and all of that, suddenly the product becomes much more comprehensive. And the person becomes engaged more and he's most likely to refer the product to 5 other friends. So that's the way to get additional consumers. But the first set of the discovery is very tough.
I think more question was on the discovery because it's, again, if you have to scale up, it is physical or digital. And digital is very challenging in terms of discovery.
It's a long path, frankly, because considering these products are tough, you need to stay put for a longer period of time. These are the products or businesses which don't get built in 2-year, 3-year time frame. You need at least 10-year horizon.
And do you suggest physical sales force or still try a digital way of selling?
I think you can take this question offline.
Please. Sorry, you don't have a choice.
Closing note, I would like to thank you each and every panelist, Deepak, Jitendra, and Gayathri ji. Thank you. Friends, please.
I just want to very quickly congratulate Abhishek for a very nice format.
Abhishek, thank you for that.
Usually thanks for that. Either a panel discussion or a presentation, and I think you've done excellent.
I think we had a good experiment.
We did it.
Hello. Friends, it's time for the lunch break and we will see you in next 15 minutes. Thank you. The next sessions we are happening.